Joining us now, Tobias Levkovich, Citi Chief U.S. Equity Strategist, joining us for his take. All right, Tobias, the bond market yesterday took it as transitory. Today we get that super strong PPI number. As an equity strategist, what do you think?
So look, we've been arguing that we're going to have a little bit more sticky inflation, kind of called 9-12 pressures. And to give you some context, we actually did a survey of our clients at the end of June. 46% of them believe that it's a kind of a 9-12 month sticky phenomenon. About 32% saying it's transitory, meaning 3 to 6 months. And you even had this residual of 12% talking about regime change, that we were looking at a very different environment for inflation than we've experienced over the last 35 years. But that's still a minority. And there are reasons to believe that it's possible, including you guys are talking about what's going on in Europe with the green revolution. That carbon neutralization has a cost that has to be passed on to consumers. It's not going to be absorbed by companies. So there are other things out there that go beyond things like these short-term global supply chain issues.
Tobias, how different is my equity portfolio if I think this is transitory or I think it's going to be a little bit more sticky?
It's hugely different. Let's put it that way. Historically, when you've seen bond yields moving up, when you've seen inflation expectations, things like 10-year tips, break-evens moving up, you wanted to own cyclicals over defensives. When you started seeing inflation wane, the reverse was the case. Now you have an overlay of that, of value and growth. And if you took the two biggest pieces of value being financials and growth being technology, and you ran the 10-year yield against that relative performance, you would see very different outcomes in terms of which of those two would outperform. So it is a very critical debate. I saw some of the people that you had being quoted in the kind of lead into this interview, and it is dramatically important to the investor. So what people have done for the most part is tried to kind of barbell on both. Is that you don't get the performance attribution if you're getting pulled down on one side and being, appreciating a part of your portfolio on the other side. So it's requiring investors to be a little bit more nimble. And our sense is that as you get to August, September timeframes, you're going to get a better sense of, is this inflation perceived as very, very transitory, or is there this more sticky notion that carries into 2022? And then the bond market could react differently with implications for value over growth. And we're in the camp that thinks that value can perform at least the last hurrah rally. Late this year into next year, you might see a pullback into growth, and we can discuss that.
Okay, so what would trigger the pullback in value into growth, say next year, particularly as value is going to struggle a little bit with those profit margins if you see inflation pick up?
So look, let's talk about those two separately. The profit margin issue is kind of a broader base. It's not unique to value stocks. It's a function of your costs are going up to deliver your products and services right now. And maybe you'll put in some pricing today, but it won't show up until the revenues until, call it, fourth quarter and first quarter. So there's this maybe just a benign lag effect between that pricing and the cost side impacting the earnings that we see. So margin pressures might only be temporary in the form of a couple of quarters, and then it gets better. But again, we're priced at a level in the markets that are anticipating a lot of good news. So if you tend to have a little bit of disappointment, stock prices get hit. And that is one of the concerns we have alongside inflation, alongside taxation, alongside even tapering from the Fed. There are a number of things that could coalesce around that August, September timeframe. And investors are pretty bullish based on our work, survey work, as well as our panic euphoria model. The second issue is, and here's really cool little piece of data that we found in the survey of household economics and decision making by the Fed, came out in May, saying that 11% of women in the country and 6% of men in the country cannot go back to work right now because there isn't school in class or daycare for their children. That's about 2% of the workforce overall. Nearly 3 million people who can't come back to work. One would hope that if we're sitting here in October, November, that changes and they are being able to come back. So the labor aspect, which is something we're worried about, could ease up a little bit. We don't have as tight labor. And that could be a trigger to reducing inflation expectation fears and hence cause that move back towards growth.
Tobias, you're kind of looking after the U.S. side of the shop. What does the rest of the world look like in a mildly inflationary environment? Europe has been perceived as the kind of the cyclical play. Volkswagen out with numbers this week. BASF upgrading its forecast, looking really punchy. Is that where you're going to get the biggest bang for your buck?
So you'll get it in a couple of places. You will get in certain EM areas as well, emerging markets that have significant, for example, commodity exposures. So LATAM, parts of emerging markets in Asia also have that. But Europe is viewed as more of a value play and U.S. is more of a growth play. Keep in mind that 55% of the S&P 500 market cap is comprised of what we will call secular growers. So think about healthcare, think about technology, media, entertainment, and kind of digital retailing. That's a pretty big chunk of the U.S. market. You don't have that in Europe. It tends to be much more financials, much more industrials, et cetera. So that is kind of the divide when you think about the composition. It wasn't always like the U.S. If you go back to 2008, 30% of the S&P 500 were those secular growers, and 30% of the market cap weight were deep cyclicals. And now that divide is 55 versus 15% in favor of the secular growers. So the U.S. is a growth trade, and arguably other parts of the world are far more viewed as a value trade.